Great. Well, thank you very much, Chris. And it's really a pleasure to be with you here today and to talk about a topic that I think is so important. And I have to say the timing is perfect. As many of you probably know, and I say that a little bit tongue in cheek, but yesterday was National Philanthropy Day. So this is especially timely. Also, be coming up on Thanksgiving and a year end, we are starting to see more and more people talk about how to share their gifts with others, as well as achieve some deduction, some income tax deductions before the year closes. So hopefully we'll have a good conversation today, and you'll leave with some good takeaway tips and ideas that perhaps you didn't have before. So that said, I'll go ahead and get started. And the first thing I'd like to just talk about somewhat anecdotally, and before I get into more of the substance of the seminar, is the joy that goes along with charitable giving. And I can speak to this a little bit personally, but perhaps more so in working with my clients, just how satisfying and how much gratification they personally get out of their philanthropic endeavors. And so if you haven't done much in this area in the past or haven't really known how to go about doing this, I encourage you to kind of put your toe in the water and give it a try, because it, aside from the financial benefits that we'll discuss today, I think you'll also find some really compelling personal benefits. So that said, let's talk more about what these practical options are for making gifts and achieving some of your charitable goals. There are essentially two ways for making gifts. One is to do it while you're alive, and the other is to do it after you have passed as part of your estate. I am going to spend most of today's time with you talking about your options to give while you're still here to do the giving. And part of the reason for that is because there's some very compelling income tax benefits in addition to estate tax benefits. The income tax benefits essentially go away if you do the gifting after you are no longer here. So while they're still beneficial to your estate and they're still very meaningful to the receiving organization, they're probably going to be more attractive if you can take advantage of those income tax benefits and do the gifting while you're here to actually participate in that donation. So most of today's conversation will talk about strategies that you can take advantage of now. All right, so let's go ahead and talk a little bit about the benefits of giving assets to charities while you are still here and alive and kicking. So one of them that I think is really very important is that when you personally make the gift to a charitable organization, you know that it's happening exactly as you intended, because you're the one managing that transaction. So your charitable goal is almost certainly being achieved as you had envisioned it. The gifts are also generally going to be fully tax deductible. And so the larger the donation, the greater the tax benefit that you are going to achieve in making that gift. Now, a couple of things to keep in mind here when you make a charitable gift donation and you're wanting to take that tax deduction. You will need to itemize that deduction on your Schedule A when you go to do your tax return filing. Now, before that scares anybody, because I know you're in good company if the whole tax filing situation is not all that appealing, the Schedule A is not a complicated form to do. It's really very straightforward. And so taking advantage of itemizing could be a really nice thing for you to be able to do without taking on a big task. The other thing to keep in mind when making a charitable contribution, you just need to be aware that there are certain AGI, now when I say AGI, I mean adjusted gross income, limits that you need to be aware of. They seldom come into play because they're really relatively high. They have somewhere between either 30% or 50% of your AGI is what you're eligible to deduct. And I'll talk a little bit more about what those two numbers mean in a little bit. But it's uncommon, I would say, in most situations that people are planning to donate anywhere near to half of their adjusted gross income. So that doesn't oftentimes become a real issue. One of the things that you have, and I sort of alluded to this earlier, but you do, as the donor, have more control over the gift. And oftentimes, if you're working with an organization, you can put restrictions on how those dollars are used. And if you have very specific ideas about how you want your philanthropy to play out, being able to be here and be a part of the execution of those plans can obviously help you achieve those goals more efficiently and effectively. And the other, and this is a benefit that really is for you, but also for the people you probably care about, and that is thinking about the people that would be otherwise executing your philanthropy if you were to delay it till after you pass. If you have an estate that's being settled with an executor, their job is a fairly daunting one. And if there's anybody on this call who has ever functioned in that role, you can probably attest to this, that it's a fairly involved role to play. And if you can make that a little bit easier for your executor by having the charitable goals that you want to do done prior to your passing, they will be hugely appreciative. So and that is, certainly part of it, but then also it can sometimes be a little bit challenging for an executor to implement these philanthropic goals you have, because perhaps the estate isn't as expected. An example would be if you had indicated somewhere in your documents, your estate planning documents, that you wanted to gift a specific amount to an organization, but for whatever reason, those dollars weren't fully available. Well, now your executor needs to make decisions about how do they go about trying to do what you've asked them to do, but with limited funds or with competing goals for those funds. So again, it's just another, I think, good reason for trying to do your giving while you're here to do it. All right, so let's move on a little bit and talk about what assets people typically give when they're being charitable. The four that almost always are the most typical ones are cash, appreciated assets, and that could be both marketable securities as well as other types of appreciated investments, such as real estate or artwork. Tax-deferred assets, such as retirement accounts, are also a possibility. And specifically for our conversation today, I'll talk a little bit about the options to make gifts from your IRA or your individual retirement account. And then the last one, which I'll only briefly touch on, is life insurance. And when you can, if you choose to identify a nonprofit organization or a higher ed institution as your beneficiary on a life insurance policy, the benefits of doing so. So recognizing those four is the ones we'll be looking at. We'll go to the one that's easiest and by far the most common, and that is cash. Most of the time, and I'm sure that many of you who are listening can speak to this personally, is that the most common way that you've shared your assets with organizations in the past has been making a gift of cash. And this oftentimes has been by writing out a check, although as we seem to be moving away from checks more and more, you may have also been using your credit card and just put it on your card. Those are perfectly legitimate ways to make gifts. They're very easy to do. The things that you want to keep in mind when you are giving this way, especially if you are going to be deducting this on your Schedule A and wanting to claim the charitable deduction, is you want to be able to verify that you made this gift. And the way in which you can do that is to hold on to canceled checks, to retain credit card statements or be able to make sure you can access a credit card statement should your gift ever be questioned. Similarly, with a bank statement, if you wrote a check or you made some other type of a debit against your bank account, you want to have that documentation. And then you also want to get written acknowledgement from the organization. Now, along those lines, if your gift is greater than $250, you need to be able to prove that you made the donation and that you didn't receive anything in return for that donation. So a receipt from the charity, and that on that receipt, it should include the charity's name, the value of the gift, the date of the donation, and a statement that says that you did not receive any goods or services in return for their gift. So those are the things you want to be careful of and be aware of when making a gift and making sure that you're taking the proper deduction for it. All right. So cash is pretty straightforward. If you have questions about that, we can certainly address that in the Q&A, but that one typically is pretty clear. Now I'll talk a little bit about appreciated marketable securities. And now we're starting to get into an area that I'm kind of excited about, because this has got some really nice options for people to take advantage of a couple of tax benefits. So I'll walk through this first, just giving you an overview, but then we'll also look at an example. So when I'm talking about appreciated marketable securities, that's really just a fancy way for me to say generally anything that you might have in an investment account separate from your retirement account. So if, for example, you have a brokerage account with a financial services firm and you trade stocks and bonds or mutual funds or ETFs, things that are very liquid and trade on an open exchange, but that generally are a part of an investment strategy that you've put in place. The nice thing about taking a gift of one of your assets in that investment account and moving it over to a charity is that you get to deduct the full value of the market value on the date of the gift, but then you also are going to avoid the capital gain tax that you would have incurred had you sold that position. So let's take a look at what that would actually translate to. So what I've done here is I've put together an example, and I've assumed you're in a situation and you want to make a gift of $1,000 to an organization. And in that gift, you're trying to decide whether or not you should write a check for $1,000 or give $1,000 of a stock that you have. And to just keep things simple, I'm just going to say, let's say it's $1,000 worth of Apple stock. Now, I'm throwing a bunch of assumptions into this so that we can kind of see how it plays out. I'm going to assume in this scenario that you are in the 39.6% tax bracket, federal income tax bracket. I'm going to assume that the stock that you're considering gifting, this Apple stock, you purchased a while ago for $700. So that's referred to as your cost basis. That's your investment in the stock. It's now worth $1,000, but you've only got $700 invested into it. My next assumption is that you're subject to a 20% long-term capital gain. So if you were to sell that stock, you would pay taxes on the gain that you've made in the stock. So I'm trying to keep this a little bit simple, so I'm not going to take into consider any state or local tax. I'm excluding thoughts about AMT and the Medicare investment surtax. They're not really going to add much value to this illustration. So in this situation, you could give the $1,000 of cash. You will then put that as a deduction on your tax return, and you'll save the $396 that you would have otherwise paid in federal income tax. So there's immediate savings to you of that income tax of just shy of $400. In the scenario that you gift $1,000 of Apple stock, you get the same income tax deduction. So that $396 continues to be a benefit to you. The additional benefit, though, is that had you sold that Apple stock, in our situation here, you would have paid a $60 capital gain tax on that Apple stock if you would have sold it and then sent the cash to the organization. Alternatively, and what I'm suggesting as a way to achieve your goal, is give the Apple stock directly to the organization. Don't sell it. Just transfer it in kind. It's a very easy thing to do if you just contact your financial firm and give them the instructions for the account for the receiving institution. They just simply sweep it over to the other account. Then the organization, upon receipt, they will sell it and take that $1,000 that they now have to go execute whatever philanthropic intentions they have with it. Because it's a nonprofit organization, they're not subject to capital gains tax. So that $60 that you would have incurred essentially disappears. So you've both saved it, but also it's not imposed on anybody else. It really just wipes that tax away. So it's a really very impactful way to try and achieve your goals and also make the most efficient use of your resources. Now, the one conundrum that I oftentimes have with clients when we talk about using this strategy for meeting their goals is, I'll say, an emotional attachment to that stock. So let's have that conversation. So assume that you gift these appreciated securities, but you really like that holding. And Apple is a perfect example. My clients who have Apple stock love their Apple stock almost as much as they love their iPhones. And so when I suggest that we get rid of some of their Apple stock, I'm typically pushed back upon. They don't receive that too well. So as an alternative, and what I consider to be a very win-win scenario, is I say, well, let's take this $1,000 of Apple stock, move it over to XYZ charity, and then that $1,000 in cash that you had originally planned on sending over to the organization, let's put that back into your investment account and let's buy $1,000 of Apple stock with that. So you're back at exactly where you were with your position in your stock portfolio, but you now own that stock at a higher basis. And so now when you go to sell it someday in the future, the capital gains tax is going to be the difference between where you're buying it at today and where you're selling it at that point, and not where you bought it at several years ago, that $700 that we had first recognized in our scenario. So they're making themselves whole in their portfolio, and they've also saved themselves some capital gains tax. It's a really great option. All right, so let's go ahead and talk a little bit about other appreciated assets. And this, I won't spend a lot of time here, but most organizations will happily take on what I consider sort of non-traditional assets also for charitable purposes. So if in somewhere in your net worth or in your estate, you have a collection of either antiques or artwork, precious gems and metals, stamps or coin collections, motor vehicles are very popular, or real estate. And real estate, I'm going to just put with the caveat that most organizations, or if you're thinking about making a gift to them, they'll want it to be unencumbered. So meaning they don't want it to be they don't want a loan against it. So if you're planning on gifting your house, your personal property, they don't want it to have a mortgage against it. Certainly talk with the organization with whom you're wanting to make the gift to see what their options are, but that's generally the rule. But most of them have a mechanism for helping to liquidate these unconventional or less common assets and turn them into very significant tax deductions for you. So, all right. So I'm going to go now to an area that I really love. And so this is one where I'll probably spend the most of our time. And in many ways, it's just sort of a continuation of the conversation that I was just having with you about gifting appreciated securities. But it happens within the context of something called a donor advised fund, or a DAF, as it's sometimes referred to. So a donor advised fund, or a DAF, is a charitable giving vehicle that's sponsored by a public charity, and it allows you to make a contribution into a fund that you have set up specifically. And you are going to be immediately eligible for a tax deduction when you make a gift into your fund. And then once that fund is set up and funded, you can then recommend grants over time to really any IRS qualified public charity. Without question, DAFs are one of the fastest growing charitable giving vehicles out there. They're extremely easy to set up and administer, and they also have significant valuable tax advantages. So I've given you kind of a very quick overview of them, but let's look at it a little bit more carefully so you can understand how these work. So when you set up a donor advised fund, you make a tax deductible donation into this fund. And it's at that juncture that the gift really occurs. That is the deduction that is going to be what you report on your tax return when you itemize. So, and you can make contributions of cash or of marketable securities, as we've just discussed, and in some cases also of non-publicly traded assets. Here, you'll want to talk with the charity or the organization that is sponsoring your DAF, but it is certainly possible to work with organizations that will take the less common assets as well. When you make that gift into your fund, you get that tax deduction right there at the time that you make the donation. It's also important to note that at that juncture, it's irrevocable. Once it goes into your fund, it's now been earmarked as money that's now intended for philanthropic purposes. You can't pull it back in. So you need to recognize that you have now set this aside for a very specific purpose. However, you now get to decide as it sits in that fund how to dole it out. And you can send it out from your fund at your discretion this year, next year, down the road. It's really whenever it's suitable for your intentions. The benefit of doing this is really kind of multifold. You get to decide when you get the tax deduction. So if, for example, you are in a year that you are getting maybe a bump up in income and you're wanting to try and mitigate that with a deduction, this would be a great mechanism for doing so. If you have some expectations about where your tax bracket is now relative to where it is going to be in the future, and you think you're in a relatively higher bracket now and you want to take advantage of the donation when your bracket is higher, again, this makes great sense. You have, again, as I mentioned earlier, that doesn't mean you're making the gift this year. I think one confusion that comes up with the donor advised fund sometimes is people sometimes think of it as their flexible spending account. If you're familiar with those at work, where you sometimes set money aside for medical purposes, but at the end of the year, if you don't use it, you lose it. That is not the case with a donor advised fund. The money goes into the fund, it's now earmarked for charity, and you can decide how and when to distribute it, and you're under no obligation to do it at any particular rate. The other thing that's nice about a donor advised fund, especially if your expectation is to maybe not make any gifts in the near term, but perhaps it's a more of a longer term time horizon for the actual granting of money to institutions, is you can invest that money while it sits in the DAF. So if you are more comfortable with a little bit of market exposure and you want to perhaps grow this fund some, you could choose investments within your donor advised fund that would allow them to grow beyond what that initial contribution was. So it is a really very strong, compelling tool for achieving your philanthropic goals. I've put together just sort of a visual of what I've just described here. But if you imagine that blue circle in the middle being your donor advised fund, you make, as you can see at step one, you're making an irrevocable contribution of some asset of yours into the fund. At that point, you're getting your tax deduction. And going forward, you decide how it's going to be invested and how you want that to be allocated among different types of asset classes. Or if you simply want to keep it in cash, that's certainly an option as well. And then as you decide, as time goes on, you make grants from your fund to the charities that are important to you. The thing that I have found personally to be very, very gratifying about my donor advised fund is the record keeping element. Not that anybody else on this call is like this, but if you are a bit of a procrastinator when it comes time to filing your taxes, it's certainly not unheard of in my house for us to be frantically looking through canceled checks to try and identify what charitable gifts we made as we try and fill out our Schedule A. This has removed that from our paradigm. Now we just pull up our donor advised fund statement. I can go and I can see the contributions that I made to it over the course of the year, and that's the number that goes onto my Schedule A. In my personal situation, we actually budget for philanthropy, and so when I know at the beginning of the year what we've sort of set as our baseline philanthropic intention. So early in the year, I look at our investment account, I identify a position that has relatively low basis, low stock basis, and not stock basis, but cost basis, and I just transfer that over to my donor advised fund, and essentially my budget for my philanthropic intentions for the year are done. Over the course of the year, if I think we need to increase our deduction a little bit, or I want to make any adjustments to the amount that goes in, I certainly can make subsequent gifts, but it still keeps the administration and the tracking of my gifts much, much simpler. It's not at all necessary for me really to be paying attention to what I'm doling out over the course of the year or the grants that I make from it, although that too is really a very useful thing, because then I can go back and say, oh, did we already meet our obligation to our church when if we've identified a certain amount there, or did we make that memorial gift to the American Cancer Society for somebody who's passed away? I have in one place a nice roster of all of the gifts that have gone in and that have gone out, and then we use that in future years to talk about what our plans are for philanthropy going forward. So it's helped us to become much more thoughtful in our philanthropy. All right. So let me go ahead to the next page and talk. And I think on most of this I may have already talked about. So you can do both a cash donation. Oh, here, but I did want to mention, because I talked earlier about the AGI limitations. If you make gifts of cash to, well, to a donor, anytime you give a gift of cash, you're allowed to do up to 50% of your adjusted gross income for deductibility purposes. On the marketable securities, that is reduced to 30%. That typically isn't an issue. I find most people their giving is under that 30% threshold, but you do just want to keep in mind that they have slightly different caps in terms of deductibility. All right, good. So now, I think I have one other question, and this actually I think I've already talked all about. I'm jumping ahead of myself. So advantages are the simplified record keeping. I think it really helps to support thoughtful and strategic planning. It gives you a lot of control over when you get to take your deduction, and then the potential for those assets to grow if you do invest them until you're actually ready to give them. So that's just a good summary of what we've already gone over. My next topic, I'll shift gears a little bit, because now I'm going to mention the giving of what they call a qualified charitable distribution, or sometimes referred to as a QCD. A QCD comes into play when you are 70 and a half, and if you are subject to something that's called required minimum distributions. So there is a provision in our tax code that says if you have retirement assets, that's fine, and you're allowed to put them into your retirement account, but at some point we want you to start taking the money out of that retirement account. And so the powers that be have decided that 70 and a half is the age in which that needs to start happening. And there is a formula that identifies how much you need to start taking at that point. Now, if you hit 70 and a half and you have this required distribution from your IRA and you don't necessarily need it, there is now this option to do what's called a qualified charitable distribution, which allows you to take the amount that either the full amount that you're required to take or some portion thereof and shift it over to a charity. And this can help to minimize your taxes. Now, the things to keep in mind with a qualified charitable distribution is that you have to be 70 and a half or older in order to take advantage of it. In any given year, you cannot do more than $100,000, and that isn't typically an issue, but there is a cap in terms of how much you can take advantage of with this QCD. And the contributions are limited to certain eligible charities. And really all that means is that somehow there was a bit of a loophole, and even the IRS recognizes that this is a bit of an oversight that may someday be corrected. But you cannot do your qualified charitable distribution into a private foundation or a DAF or a split interest trust. So if you are wanting to do the QCD, that distribution from your IRA, it needs to go directly to the charity that you want to receive it. And that's a really important point. There was a situation that I had heard of once where somebody thought they were doing this, where they took their minimum distribution and they took the check over to the charity and just endorsed it to them. And that's not allowed. You actually work with the custodian of your IRA. You tell them who the charity is and give them the information, and they send it directly to them. You cannot receive these funds, nor can you be identified as the payee if they're sending a check. So just keep that in mind if the QCD is something that you think you would like to do. With the QCD, when it comes out, it really comes out of your IRA without any tax implication whatsoever. Essentially, the government just doesn't even think you received it because you didn't. It doesn't even show up as income and that you need to report. So it obviously is one of the benefits is that it helps to satisfy that required minimum distribution obligation that you have when you turn 70 and a half. Okay. So I'm going to now talk just a little bit about life insurance. And so one other strategy that you may want to consider is naming a charity as the beneficiary of a life insurance policy. And it can be a very simple way to move assets to, and not even move assets, create assets essentially through the death benefits, but to a charity at your passing. There's no income tax benefit in this particular strategy, but it does allow you to probably achieve your objectives by getting assets to an organization that's very meaningful to you. A couple of things that are nice about life insurance policies for charitable purposes: it does provide privacy. It really allows money to move from one entity to the other without it passing through probate. It's a very clean process. And it's generally incontestable, meaning that a beneficiary designation it's almost impossible for anybody to question the validity of that. And I'll just take this opportunity to say, in general, your beneficiary designations, whether they be on life insurance policies or retirement accounts or IRAs, and whatever it is that you have, are pretty rock solid. So they are something that you probably should be checking on a regular basis as part of your sort of financial review process to make sure that they are up to date and reflect what your current intentions are. So because it's very hard to undo what a beneficiary designation suggests. All right, so I'm going to, I think, pause there and see if we have some questions. And I think one came in, and let me just read the question here. It says, tax deductibility, meaning that if I give $1,000, will $1,000 be reduced from my tax liability? That's a good question. It's not a credit. What you're suggesting, I think, here is that if you're giving $1,000 away, you don't get to subtract $1,000 off of the tax due, but you get to subtract $1,000 from your income, which then you calculate your tax. And if you have less income, then you're going to have less tax. So it's not a dollar for dollar offset. That would be a tax credit. And they're hard to come by. They're, for good reasons, the government who is wanting to raise revenue, they don't offer many tax credits. They just offer primarily opportunities for you to take deductions and reduce your liability that way. Is there a good formula to understand what my reduced tax liability will be from donations? The best way is to just look at what tax bracket you're falling in and then multiply that by the amount of the gift. So as in this scenario where I showed you that $1,000 gift, I assumed that the donor was in the 39.6 tax bracket. So then I would just take 39.6% times the gift, which is $1,000, and I came up with $396. So that person should realize a $396 reduction in their tax bill when they go to do their 1040 at the end of the year. So, a good question, really good question. Taxes are not always all that clear, and as they're negotiating today up on the Hill, we're probably going to see a few changes. Any other questions? And actually, you know what I'm going to do? Before I do that, I'm going to just take a moment here because one person I think you really have as a great resource to you is John McKee. John is the executive director of gift planning at the University of Maryland. And all of the things that I've talked about here today, he's extremely familiar with, and he's worked with many, many people to help them put in play a giving strategy that is appropriate for their goals and their budget. And he's a great resource. And if you're wanting to make some gifts and support a wonderful institution, please make sure you take advantage of John and his expertise. So, all right, so I'll leave that there just for a second, but if you have any questions or want to know how to get in touch with John, you can reach out to me and I'll share my slide deck with you so that you can have all of this contact information as well. And so that said, I'm going to go to my next slide here, just as the Q&A slide. And at the bottom here, I have my contact information, and I'm happy to follow up with any of you that have questions, or if there's anything I've said here today that you're curious about or want to learn a little bit more about. I'm certainly happy to talk to you about that, or you can take the slide deck and talk to your own financial advisor and see what works for you. So that's, I would have to be welcome to have that conversation.
Thank you,
All right, so
Melanie.
are there any questions? Yeah.
So we'll go ahead and like you mentioned, we'll take some questions. And just a reminder for everyone, if you were to look at your GoToWebinar control panel, there is a questions tab. So if you just click that arrow down, you can type your questions in directly there, and then Melanie will be able to respond to any questions you might have.
Wow, I was more thorough than I thought, or maybe everybody knew everything. All right. Well, if there are no questions, is it okay, Chris, if I just once again mention to people they're welcome to excuse me to contact me, and I'll share the slide deck or be happy to follow up with anybody who has anything. Oh,
Yep.
wait, was there something that just came up on minimum distribution, or did I? Oh, oh, let's see. There is a question. How often are donor-advised distributions to a charity required, and what is the minimum amount? Oh, that's a great question. I'm sorry, I should have covered that. So there is no required distribution from the DAF. You can do that as you wish. You can let one sit there and kind of percolate for years and years and years, and then eventually decide to make a gift down the road. And that's a really important distinction between a donor-advised fund and a private foundation. Private foundations, which used to be kind of the tool of choice, do have an obligation to send out a certain amount of funds each year. So, but you don't have to do that. The minimum distribution, that is going to vary a little bit from organization to organization. I mentioned earlier, I sit on the advisory board for the Community Foundation here in the National Capital area, and we offer a donor advised fund. And I think that also the Community Foundation works very closely with the University of Maryland. So, and their minimum grant is $250. So whenever I'm going to make a gift to somebody, I just have to make sure that it's at least $250, which I have to say has been kind of a nice feature because it's prompted me to be a bit more thoughtful about my giving, as opposed to, $50 here, $100 there. Now I just sort of, when I'm approached, I say, I've now decided to make sort of more significant gifts, and in a thoughtful way that I plan out ahead, and knowing that 250 is sort of the minimum that I'll be giving out. There may be, and I don't know off the top of my head what some of the other organizations are. I know Fidelity and Vanguard, all of the big financial firms, RBC where I work, we all have donor advised funds, but they're all sort of in that $250 range, I think, for grant purposes. Right. And another one left. Oh, how would one leave real estate to a charity? Great question. Definitely call the development office. In the case of University of Maryland, just give John a call and he can help you with that. It's a little bit more involved, but it can be very, very useful, especially, if you've got some undeveloped land somewhere that you've inherited that you don't want to be bothered with, or whatever it might be. But it's certainly very doable. Usually then the organization will work with an appraiser to identify a price, and then with a real estate agent, because they don't typically want to hold it. They'll oftentimes liquidate it shortly after receiving it, but that's something they're going to be familiar with, and they're going to make that process pretty straightforward and pretty simple for you. Oh, another question. Are there administrative fees associated with the DAF? Yes, there are. I'm going to say in general, you'll probably pay around 1% as an administrative fee. That seems to be what I typically see out there. If it's a larger one, that fee comes down, as many times when there's economies of scale. If you start really funding it with significant assets, that'll probably be less. But 1% is kind of, I think, a good gauge for what the administrative expense would be. See, was there another question there? I think that's it. Oh, no, here, I'm sorry. I'm just making sure I'm scrolling through these okay. So a question about, um, somebody is a trustee for an estate and getting payment for services. Oops, one, I can't scroll. How do we best decide how much to start with a donor advised fund? That's a great question. I guess I'd have to know a little bit more before I could really probably give you any good advice on that. But if once it goes into the donor advised fund, the key thing to make sure you're aware of and comfortable with is that it's irrevocable, so you can't pull it back out. I would probably, like I oftentimes with most of my clients, say, start small just to get a feel for it, get some comfort level with how it works, and that you find that it works well for what your circumstances are. You can always add to it. It's the simplest thing in the world. Just last week, I made an additional contribution to mine. I just swept over some stocks that I had, and they were there a couple of days later, and at my and I've already made a gift from them. So it's, but I would generally, like whenever you're starting something new, I say you can take it easy and start modestly, and then as you become comfortable and you become satisfied with it, it's always easy to augment that. And let's see. Was there another question? Okay, so this question, I was afraid of this one. How do you think the tax debate on Capitol Hill might change some of what I've discussed for next year? I want to pretend like I didn't see that because I still feel like there's so much we don't know as they continue to sort of banter about the possibilities. I don't think, I mean, the one thing I think that could be most impactful is if they're going to raise the standard deduction, then the itemizing deductions will become less attractive, that more people will find that their giving is going to fall within the standard deduction and won't need to do the Schedule A. That would probably be the biggest impact. Other than that, I mean, we're not seeing that there's much discussion about any changes to the capital gains tax, which is an important one. And for the most part, brackets aren't materially different. I mean, I know this House and Senate are looking at two different collection of scenarios and different brackets, but um, I don't know that there's going to be any really significant impact on what they're discussing and what I've said here today. And I'll say that somewhat with the caveat that we'll kind of TBD and we'll see how these things play out. Let's see. I think, oh, and the minimum amount to open a DAF. Another great question. With the community foundation, if you wanted to use them, they start at $10,000. I want to say some of the financial firms will go as low as 5,000. I've never seen anything lower than 5. But as these continually get more and more popular, I wouldn't be surprised if we see that. We're finding them that they're really becoming very, very common for people wanting to use, and making them accessible and reducing sort of those barriers to entry will be key. So, but even at 10,000, it's especially this year where people are looking at a lot of appreciated securities in their portfolio. That's not for many people such a big a gift to be made, and then especially given that you can spend many years if you wanted to spread it out over a while, you certainly could. Oh, all right. I think that's it. Am I need to see if I've missed anything? I think we're good.
All right, well, it looks like we covered all of the questions. Melanie, is there anything else you want to cover before we wrap up?
No, just thank you so much for this opportunity. You let me talk about something that I love to talk about. It's so fun for me to watch people make philanthropy a part of their financial plan and feel so gratified and get excited about what they can do with some of their assets. And like I say, if you haven't done it before, give it a shot. It's really, it can be a very wonderful thing. And now there are many great ways to do it, and in ways that can really be beneficial to you as well. So thank you. It was a great opportunity.
Great. Well, thank you, and thank you everyone for joining us today. If you would like a copy of the slides from today's presentation, as mentioned previously, please contact Melanie directly, and we hope you will join us for a future webinar. Our next one, Can We Talk? Navigating Conversation in a Multicultural World, is actually happening tomorrow from 11:30 a.m. and starting a little bit earlier. So tomorrow, Friday, November 17th, starting at 11:30 a.m. Have a wonderful day, and go Terps!